Ever wonder why some popular investing trends can sometimes lead to financial disaster? Let's jump into this. Welcome back, Insiders. My name is Bill Smith, CEO and founder of W.A. Smith Financial Group. Today, we're going to be diving into the fascinating world of herd mentality in investing, and we're going to uncover why it's a strategy that could send your portfolio into a very dangerous place. All right, we're going to talk about three things as we break this down. Number one, what is herd mentality? And let's kind of understand it. Let's start with this one. Do you own a Stanley Cup? Well, if you know what I'm talking about, why did you get it, right? If you don't know what I'm talking about, you're probably going to Google it right now and you're going to own a Stanley Cup because you want to be part of the group. You want to be cool. You want to be like one of the cool kids, right? So it's following this herd of people who are doing it. You want to be part of a larger group. Now, when it comes to investing, this can be extremely dangerous. So the Dalabar's Quantitative Annual Analysis of Investor Behavior, it's called their QAIB report. It's an annual study. It consistently shows that the average investor underperforms the market by a significant margin. For example, during the 20 years ending December 31st, 2022, the average equity investor earned an annualized return of just 5.32%, while the S&P 500 index returned 9.85%. That underperformance is often attributed to panic selling during market downturns. Again, could be following herd. So let's break this down. Why does this happen? And so when we look at the definition of herd mentality, it's simply following the actions of a larger group for fear of missing out or fear of something, right? Could be fear of loss. If you sell an investment before and you don't stay invested, your fear of loss kicks in. That fear of loss is such a big motivator when it comes to individual investors. So the psychology of herd investing or herd mentality really hones in on two parts of fear of loss and fear of not participating in gain, right? So it's that fear of loss and the fear of missing out, FOMO, right, if you will. So when it comes to investing, those are the two, fear and greed are the two biggest motivators as it comes to the herd mentality. So the key here is, number one, I think, understanding that it exists and knowing that it's driven by a fear of missing out or a fear of loss. Really important. And if you have an advisor and a written plan, this can go a long way in helping you allow this, what I would call, can be dangerous behavior. Okay, second point I want to discuss, the dangers of herd investing, which I alluded to a little bit, but according to an article that was written by Forbes, during the Great Recession of 2008, U.S. equity markets dropped about 38% in just 6 weeks due to widespread panic selling. Again, following the herd. Doesn't help when the headlines are everywhere. But when you look at the market that dropped nearly 40%, had already rebounded 10, 20, 30% or more before some of these people bought back in. So if they had just done nothing, they wouldn't have lost any ground at all. So those who engaged in the panic selling following the herd selling in 2008 may never hit their financial independence, or at least on their time frame when they wanted to retire. So they never really fully recover. So instead of learning from a 2008, some people did the same thing during the COVID-19 pandemic that was just a very short and precipitous drop during that time frame. So there is no one-size-fits-all solution. At the end of the day, the reality is when you think of, it goes back to looking at what are the economic drivers behind it? What is the economic situation? And knowing that psychology can get in the way sometimes of those things. So the key here is removing emotion as much as you can. And also understanding, are there bubbles in the market? And is there panic selling happening? And so if you can recognize bubbles and some of these panic selling things, it can actually put you in a pretty good place. But nobody has a crystal ball. Our mind broke 29 years ago. The reality is you need to have a solid plan, and you just need to know that this psychology exists. This following this herd mentality exists. All right, the third thing I want to discuss is, how do you avoid this herd mentality trap when you think about it? Well, number one is learning from the mistakes of others. And really, history does tend to repeat itself, and especially financially, right? We go through cycles. We go through different economic cycles. If you rewind back to 2008, what did you learn from 2008? That if you would have just done X, how would that have helped you? So it's not repeating those same mistakes over and over. And just because your neighbor does it, does that mean you should do it? Just because the guy that cut your hair, your barber, are talking about the hot stock tip of the day, should you sell your entire portfolio and go do it? You get on the bandwagon of gold. Again, you have to learn from those prior mistakes. So how do you do it? You develop a strategy. You develop a comprehensive plan, and you separate yourself from the emotion where you are making those decisions, and you have somebody that's kind of guiding you on a written investment plan. And also, I would tell you, it's a good idea to do your own research. So, a plan's only as good as the advisor you're working with. You want to make sure you're working with a fiduciary, someone who will give you a written plan, someone who is focusing on your long-term goals and objectives, so that when you seek that professional advice, you kind of know some of this framework that you should be looking for to help you avoid being a part of this herd mentality that can really crush an investment portfolio. All right, that's it for this week's Send 360 Insider. Do you have a specific question or topic you'd like us to cover? Leave me a comment in this comment section below and let us know. Thanks again for tuning in. I'm Bill Smith. See you again next week.